March was a volatile month for Indian equities, driven by geopolitical tensions, crude oil swings, currency pressure, and shifting institutional flows. The market reacted to West Asia developments, elevated crude prices, and a weaker rupee, while the global policy cues, especially from the US Fed, continued to influence risk sentiment. To help us decode what this means for Indian equities in the month of April, we have with us Ms. Shibani Kurian, Fund Manager and Head Equity and Research at Kotak Mahindra Asset Management Company Limited. Welcome to the show, Ms. Shibani.
Thank you so much. Pleasure to be here.
So we know March saw heightened volatility as Middle East tensions kept crude prices elevated and market risk-offs, right? Is this largely headline-driven volatility, or does it changes the way investors should think about April positioning?
So, of course, the biggest factor that is impacting markets today is what is happening in the Middle East and the conflict and its impact around the world, including India. So, Indian markets have clearly hit a speed bump in that respect. So, when you look at Indian markets, there are two key factors that will possibly drive markets going forward. First and foremost, the most important factor will be when the conflict ends and therefore the resolution of the conflict and the duration of the conflict lasting. And the second important factor is what is the new normal post the conflict ending and post the resolution as far as the conflict goes. Now, both of these are unknown, and therefore it is possible that in the near term, we will have to navigate volatility as far as markets are concerned. When you take a step back and you look at what happened during the Russia-Ukraine crisis, at that point in time, the markets bottomed out in terms of valuation, with the Nifty at about 17 times on a one-year forward earnings estimates. Today, when you look at Nifty, on valuations, we are at about 18 times on one-year forward EPS consensus numbers. Therefore, from a valuation perspective, we are close to the last bottom that we had seen during the Russia-Ukraine crisis. However, there are still considerable amount of uncertainties at this point in time, which is why we believe that from an asset allocation perspective, one should be neutral to equities in the overall asset allocation bucket.
So please tell us, what could be the impact of higher oil prices on macros and corporate earnings?
Yeah, so that's a very, very relevant question today. Now, the good part for our macros and for our economy is that we started from a position of strength. So inflation was under control, GDP growth was showing signs of improvement, and the current account deficit was also largely under control, and RBI had enough forex reserves. So therefore, the impact that you're likely to see because of the conflict is on the back of India's macro being in a strong position, which is a silver lining in this current context. Now, the rule of thumb is that for every $10 increase in oil prices over the year as a whole, with everything else remaining constant, the current account deficit gets impacted by about 40 basis points. Inflation on a direct basis gets impacted by about 30-35 basis points, and GDP by about 15-20 basis points. Now, this is, of course, assuming that oil prices stay elevated for the remainder of the year. Now, as far as corporate earnings are concerned, there will be some impact because of the supply chain disruptions plus increase in terms of input costs. Again, the big variable is how long this conflict really lasts. So today, if you look at March consensus estimates on Nifty EPS for FY27, there have been minor tweaks, but nothing major as of now. And therefore, we will keep watching this space. Our view is that there will be some impact likely on corporate earnings in the first quarter of FY27 because of higher input costs. But by then, if the conflict ends, focus will again move back in terms of fundamentals and earnings for the remainder of the year.
So what is the view in terms of sectors which we are positive on, which could help us navigate the current market environment?
Yeah, so the markets are volatile, and I think most of the sectors are getting impacted in some way or the other, either directly or indirectly. The best way to navigate the market today is to focus on domestic facing sectors that derive demand from domestic sources and where valuations are in your favor. In that respect, from a sectoral perspective, there are three sectors that I wanted to highlight. One, the banking financial services sector. Credit growth has been improving. Our belief is that credit costs in the system are fairly low. Even if there is some inch up, it is fairly manageable. and banks are well capitalized. More importantly, they are trading at valuations which are significantly below their long term average levels. The second sector where we are positive on is the healthcare space, specifically hospitals. There is, of course, demand for high quality healthcare. As per capita GDP improves structurally, people want high quality healthcare, and therefore, occupancy levels in hospitals are improving, resulting in better profitability. The third sector that we are evaluating and where we believe there are pockets of opportunity is the industrials and capital goods space. Here we are focusing on new areas of investment and capex, which could be segments such as data centers, green hydrogen, or anything that is related to power transmission equipment and the like. Net net, look at sectors where there is still visibility of earnings growth, more domestic facing sectors, and more importantly, where valuations are in your favor.
So, Ms. Shibani, we saw a clear FII selling versus DII buying pattern through March, right? How important is the domestic liquidity support for April if the global risk sentiment remains fragile?
So, the domestic liquidity support for our markets have been very important, not specifically for this month, but over the last few years. So, just let's put data into context. In the month of February, we saw FIIs turning net buyers, and since then, they have turned net sellers by a vengeance. During the same period, DIIs have been net buyers of Indian equities. So, if you look at the calendar year to date, DIIs have supported the markets by being net buyers to the tune of almost $26 billion as we speak. And therefore, DII support is important. What we have seen in terms of trends is that flows remain fairly stable. Most importantly, SIP flows are sticky in nature, and therefore that support is important for our markets. This is a trend that we will keep a close watch out for. So, on one hand, it's very difficult to predict what FIIs will do, but this time around, the domestic institutional investor support, because of participation through the SIP route, has been something that has lent stability in parts to the market.
So, lastly, what will be your advice to the investors in these market scenarios?
So, for the markets, the situation that we are navigating, the situation of volatility, is clearly something that, as an equity investor, over long periods of time, there will always be points when markets face that kind of volatility. And therefore, navigating such volatility is part and parcel of investing in equities. So, the most important factor when you encounter such a situation is to stay disciplined, focus on asset allocation based on your risk profile, and look at the long term. SIPs always continue to be the best way to invest in markets. From an asset allocation perspective, what we are really saying is that be neutral to equities in your overall asset allocation bucket. Use corrections to build to equity positions depending on where your risk appetite is. At this point in time, our belief is that mid caps and large caps are better placed given the valuation as well as earnings outlook. But net, stay disciplined and stay invested.
Thank you so much, Shibani, for joining us and sharing your valuable insights on the evolving equity landscape.
Thank you so much.
So, we hope this conversation helps our investors navigate April with more clarity and confidence amid ongoing the global and domestic cross currents. For more such conversations, stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.